let's set the scene. We talked about the first half of 2025. At the start of the year, the 10-year yield was at 4.56%. It rose to 4.8% shortly before Donald Trump took office. After Liberation Day, it sunk to 3.86%. Now we're stuck at around 4.27%. That's a pretty wide range, and it feels like everything has been priced in at some point during this year. What's not priced in?
So I'd say, what's my trade? So, by the way, I'd say a couple of things. By the way, the best return opportunity this year across debt and equity markets is to sell volatility, because it's been actually pretty amazing. Like you talk about these ranges, the markets tend to move one way, and then you could sell one side of it, and then the other. Selling volatility rates and equities has been a good trade. What's not priced in? Listen, I think there's something that's going to happen over the next year or so that I think is pretty spectacular. One, I think it's pretty clear. I was watching the interview with Secretary Bessent today. Fed is going to bring rate down. Second thing that's happening, you've had, and he talked about it, inflation has come down. The 3-month moving average core CPI is 1.7%, pretty impressive. The thing that I think is not priced in nearly as aggressively, what's going to happen around automation, productivity, robotics, AI, is actually we're going to move to a place where we're going to reduce the rate of inflation on a persistent basis. And I think that's the thing that people are going to focus on. Part of why I talk about buying the 5-year point on the yield curve. People say, where are the forwards priced? I think it's something that's going to be pretty interesting. Part of why I know I've said this is a golden age of fixed income, not because we're going to make a lot of money in interest rates. You're getting income now that's pretty spectacular.
Right.
Where we're entering a point in time that's pretty exciting around how the world's going to change.
So you just said a whole bunch of interesting things. I want to focus on what you're talking about when it comes to the long-term effects of AI and other forces. When it comes to inflation, and that'll be a downward force when you extend the time frame a little bit. Can you invest around that rate now? Because maybe that's the long-term picture, but there's plenty of fears about inflation in the short term.
So the answer is yes. I mean, you look at it in the equity market today, not just the traditional hyperscaler investments, but as well the companies that are involved in cloud, software, energy, cooling. And you think about how well, you had the DeepSeek thing in February, which was, I like in our global allocation funds, I like tech, I like investing alongside this space. That was a wake-up call, like you still got to be careful about your beta. Technology's changing, but I think that paradigm is real. So then you talk about, so let's relate that to what does it mean for interest rates. I think people underestimate. I mean, we use AI in functionally everything we do now. It's going to change the world.
Wow.
And it is going to change the world around increasing productivity. By the way, for the U.S. economy and for the debt situation, if we get to a place where you can grow faster and you have a more productive economy, it means great things in terms of bringing the debt down, which I still think today is the biggest tail risk we have in the system. But if that plays out, if that economic transition plays out, that's pretty powerful.